Hello, everyone. My name is Lauren Antone, and I'm the Senior Marketing and Events Coordinator at MAR, as well as the producer of our free webinar series. Our webinar today is 1031 Tax Deferred Exchanges. This webinar will help you to understand how to defer paying capital gains taxes when you sell an investment property and reinvest the proceeds in a property of like kind. We will talk about rules, concepts, and definitions you should know if you're thinking of getting started with a Section 1031 transaction. After our live session, the webinar will be recorded and added to our website at marealtor.com. If you have any questions throughout the session, please type them in the bottom of the chat box on your screen, and we will hold a Q&A afterward. Our presenter today is Lynn Bagby. Lynn Bagby is the New England Division Manager with Asset Preservation, Inc. She has earned the Certificate Exchange Specialist designation from the Federation of Exchange Accommodators. Working throughout the Northeast since 2000, Ms. Bagby has facilitated thousands of various types of exchanges and is committed to quality customer care, as well as providing the most current information available with regard to IRC 1031 and the client exchange process. Asset Preservation, a subsidiary of Stewart Title Company, is a leading national IRC 1031 qualified intermediary and is efficiently handling exchanges in every state. Asset Preservation is one of the most respected national qualified intermediaries in the United States and has successfully completed over 150,000 1031 exchanges throughout the nation. Ms. Bagby has been educating and servicing investors, attorneys, real estate brokers and agents, accountants, financial advisors, and mortgage bankers, brokers for the past 14 years. She has taught continuing education classes in all 6 New England states, appeared as part of local and national educational exchange panels, and has been a guest on real estate-related radio programs geared toward real estate investors. Her exchange presentations are practical and feature many real-life exchange scenarios to illustrate a wide range of investment and tax strategies. So, without further ado, now over to Lynn.
Hi, well, Lauren figures out how to advance my slides for the presentation. I want to thank her very much for introducing me and look forward to presenting Section 1031 to you in a usable fashion where you'll be able to identify clients that might qualify for a 1031 exchange and specifically their interest in investment property, what works, what doesn't, and some of those things you should know. Before we get started, there's my bio with a couple of corrections because Lauren's got the old copy. Before we get started, I do want to just preface the presentation by saying, as real estate agents, I want you to think about real estate because this is still a real estate transaction. Someone's selling something, someone's buying something. The election of Section 1031 makes it a tax transaction too. So one of the things you need to keep in mind is that this is for investment property and that the 1031 election is a tax election taken by the taxpayer on the sale of their investment property. So if you keep those couple things in mind, it's going to make this presentation make a lot more sense to you. So we should be on the outline page, and some of the things we're going to cover today, there's quite a few. I'll try to speak at a slower cadence because usually I speak a mile a minute, but the outline's going to feature hold, seller, exchange. We're going to talk about the different things that a property owner needs to think about before they dispose of their property. Investor motives. What types of things do investors think about when they're investing in the real estate? We'll talk about capital gains taxation, the description of Section 1031, the exceptions to the 1031 tax code, property held for sale. What's the difference between property held for sale and property held for investment? Basic 1031 guidelines. What is like-kind property? Holding for investment and the intent to hold for investment. The exchange equation, which basically talks about the math formula. Partial exchanges and the closing costs, discussing allowable costs of sale and non-allowable costs of sale when you're dealing with a 1031 exchange. Tax ownership and how you hold title to real property, because one of the things I'll tell you early is tax ownership needs to stay constant throughout the exchange process. The role of a qualified intermediary, which is the role that I speak to you from today. What exactly is their role in the transaction? We're going to walk through a delayed exchange format, which is the most popular exchange format, where you sell first and then buy properties after the sale, because there's different formats. The identification rules, how to properly identify property. One of the things that's so important and near and dear to my heart, especially throughout Massachusetts specifically, but many other areas of New England, is the split treatment transaction, and all about those owner-occupied multifamily properties where they live in part and they rent out part. So that's one of my favorite sections of the presentation. And then this, if we have time, the steps to a successful 1031 exchange, and a quick look at the like-kind exchange form, how you report your 1031 exchange transaction when you do your taxes. Those are a few bonus features. If we get to them, great. If not, Lauren's going to make the PowerPoint of this presentation available to you by emailing into her. She's going to send you a copy if you'd like to have it. So without further ado, let me get into the program itself. So when someone is selling their real estate or their real property, first of all, market conditions play a key role in this. For those of you that have been a real estate agent or realtor, pre-recession, during the recession, and post-recession, one of the things that people that had bought their property at the height of the market experienced the dramatic drop in pricing. Some people ended up selling out at a loss, but some people decided, you know what, I think I'm going to sit here and hold on to this property until the market comes back, and then I'll do something about it. So in a down market, which we're not in now, a seller, an owner of investment property may decide to hold that property until the market comes back and they can sell it when it's appreciated. So at that point in time, you have a decision to make. Do I outright sell it and pay those capital gains due on that property and then redeploy that property into other areas of investing? But the issue with that is that you take a big loss when you're selling appreciated property that you've held for a while and you've experienced a great rate of appreciation. You may be taking having a big gain and then have to pay a lot of taxes on that gain. Now, if you've only held it for a couple of years and it's appreciated, maybe the gain is not that big, so that a 1031 may not make sense for you. But most cases where people are in this scenario like I described, and a lot of what the sales that I'm seeing look like now, someone has held a property through the recession, now we're at a peak market, now they decide to sell, they're faced with huge capital gain and therefore a lot of taxes. So a 1031 exchange allows you, taking this tax election on the sale of that investment property, allows the taxpayer to defer all those capital gains taxes with a fully deferred Section 1031 exchange, and if they're buying equal or greater in value than they sold, or doing a partial exchange by buying other investment property at a little bit less value, pay a few taxes, and then defer a good portion of that gain. So a Section 1031 can do that for them. While we're talking about 1031 exchange, I want you to keep in mind that this is a tax planning strategy. This is a tax election that you can take when you're selling appreciated investment property. It's continual. You can continue to exchange throughout the course of your lifetime, so it's not a one-shot deal. So people need to be thinking about this as they're invested in real estate, because if they don't continue it, say they sell an appreciated property, do a 1031 exchange, reinvest into like-kind replacement property, and then afterwards cash out, they're paying taxes back to the very beginning. So with proper tax planning, you don't need to do that. You can continue to exchange throughout the course of your lifetime. We're going to talk a little bit more about that when we get to estate planning. So, which is at the bottom of this page. So let's take a look at what investor motives are. So investors can increase their rate of return by leveraging. So say they've got a property that they're selling, highly appreciated, and they decide they want to leverage that gain, that money. They can do it across several properties, or they can buy a more expensive property and buy something greater in value and leverage those funds. They can also diversify. Say they have just a single family rental property, and now they want to buy a multifamily property. Maybe they want to buy a piece of raw land and hold it for appreciation, or maybe a mixed use property where there is a retail on the bottom and living quarters that they can rent out on the top. So they're able to diversify into different asset classes of real property. They can also consolidate. For example, I have an investor now that has 33 single-family residential rentals, and he has sold them and is buying a large apartment complex so that you can consolidate. You can sell multiple properties and buy one larger one. An increase in cash flow. I've seen situations where there are people that own investment property and they've had the same tenants for a number of years. And we just know that that steady rental income is a positive, so they haven't raised the rent. But they want to take advantage of the high appreciation in the area and maybe find something in another area where maybe they could buy it at a good price and increase those rents, so have an increase in their cash flow. Management relief. This specifically happens where I see it all the time in my role, where people call and they say, you know what, Lynn, I'm going to sell this investment property, but I just don't want those management responsibilities anymore. There are passive income properties out there that work well in Section 1031 that allow someone to be able to get out of a property that they don't want management responsibilities in and get it invested into property, real property, that the property management comes with it. Or they can buy a property and hire a property management company to run it for them. An increase in depreciation. If you've got a pencil and paper handy next to this topic, you may want to write this down, but residential real estate depreciates at a rate of 27.5 years, commercial at 39. So if someone's purchased a property and say it's a residential, they've owned it for 10 years, they sell it, buy a property of greater value, they're going to get more depreciation because the property is more expensive, and then they get to continue their depreciation schedule. And then estate planning. I mentioned to you that you're able to exchange throughout the course of your lifetime. The interesting thing is in estate planning that if you have an estate planning attorney helping you, but you can leave your property to your heirs. They get it at a step up in basis and that tax deferment goes away. So it's very important that when you start on this 1031 journey that you keep in mind that you can use it repetitively and put investment properties as part of your estate plan and leave it to your heirs. They'll get that step up. Okay, capital gains taxation. This is the big thing. Many people think, oh, geez, I just have to pay that federal capital gains tax when I sell. Stop, hold the phones. Not necessarily true. The capital gains taxation includes 4 components. So if you live in if the property is in a state where there is a state capital gains tax, you're going to have 4. Where there's no state capital gains tax, you would have the 3. But this is what it looks like. Capital gain taxation includes these. First of all, the first tax that the IRS is going to charge you with is your depreciation. You've been taking those depreciation tax credits on tax returns while you've owned this investment property. Well, the value of that, based on the number of years you've held the property, is going to get taxed at a rate of 25%. Keep in mind, this is a federal tax code, as is Section 1031. Section 1031 is a federal tax code. The depreciation recapture tax is a federal tax rate, and it's a flat 25%. The federal capital gains tax is issued on the capital gain minus the value of that depreciation at either 15 or 20%. And if you look at the star below, it gives you the thresholds for when that 20% tax code, the 20% tax rate would apply. If you're under that, you're in the 15. And then the 3.8 net investment income tax, formerly called the medical care surcharge tax, which was part of the Affordable Care Act, which came out in 2012. This tax hit in 2013, is on net investment income. Well, what's that? Net investment income is that income that you did not earn a W-2 wage or a 1099 for. It is the capital gain on the sale of your investment property. It is stocks or bonds that you've sold. It is your rental income. Again, it's anything that you did not earn a W-2 or take a 1099 for. Most people, especially in New England, are liable for this tax if they've held on to that investment property for a while, because there's people exceeding those thresholds, which is to whether this tax is liable or not would be if you're earning $200,000 as a single filer in passive income or $250,000 married filing jointly. Then the entire gain on your property would be taxed at the state capital gains tax rate at 5.2%. So before someone ever sells their investment property, they do want to meet with their CPA or tax advisor to be able to get a handle on how much capital gain they have, how much capital gains taxes they would have to pay, and therefore, if they take that Section 1031 exchange tax election, how much they could defer if they stay invested in real estate. So this is what the tax code says. It's a very short paragraph, but we're spending an hour talking about it. And as I was telling Lauren earlier, and some of you that may be on this call that have actually taken a CE class from me, it's something where I could talk about it an hour, 2 hours, 3, and up to 6 in some states. So, but it's all about this little paragraph. It says, no gain or loss shall be recognized on the exchange of real property for productive use in a trade or business, or for investment if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. So the next set of slides are going to talk about things like what is real property, what is like kind, what does held for investment mean, and how does Section 1031 work. Let me start with the exceptions because it's a shorter explanation. First of all, this is what does not qualify. What does not qualify under Section 1031 is stock in trade or other property held primarily for sale. So then what does that mean? Well, stock in trade or other property held primarily for sale would mainly mean real estate as inventory. It could also mean builder or developer property, or for rehabbers and flippers. So let's kind of take another little closer look at that. So when a builder goes out and buys a plot of land and decides to construct a property and turn around and sell it, what is his intent? His intent is to sell the property, not to hold it for productive use in trade or business. It doesn't make a difference if it's taken him a year, 2, 3 years to build that property. Still, his intent would be to sell it. He's building it to sell it. Well, that's kind of the same concept as a developer who might be buying land, building a project on it. I'm thinking of a residential, say, or a commercial like an office park or a retail plaza, okay? Or a rehabber that's buying something that he's going to it's run down, dilapidated. He purchases it. He does a gut rehab. His intent, if he puts it right on the market, is to sell it. So in this case, in these three scenarios, the intent has been to sell. Now, let me segue to say it does not mean that property flippers, builders, or developers cannot exchange. They just cannot exchange this type of property, because usually, in many cases, some of these same people have a different business entity for their buy and hold properties. So I don't want you to walk away thinking that developers, builders, or rehabbers cannot exchange, just not on property that they are fixing to sell. Something that they're going to hold for investment could qualify. Again, usually they hold it in a different business entity. Stocks, bonds, or notes. So if you're selling a stock, even if it's a real estate investment trust, which is it's a stock on real property, not exchangeable because it's a stock. Okay. Other securities or evidences of indebtedness or interest. What does that mean? It means that you cannot sell a piece of your investment property and pay off a mortgage on another property, even if it's another piece of investment property, because basically you'd be selling a piece of real property and paying off a note, which is a financing tool, not like kind. Interest in a partnership, I see this a lot. I'll have people that want to sell, or taxpayers that want to sell out of a piece of investment property and buy into an entity that owns a piece of investment property. A partnership or an LLC taxed as a partnership is a business entity. That's what owns the real property. But what happens in a lot of situations is people want to sell their investment property and buy into the partnership that owns a piece of property. You cannot do that. A partnership could sell you a piece of that property where you hold title to it at your percentage of ownership yourself, but you cannot buy into the entity. A certificate of trust or beneficial interest, same thing. You cannot sell a piece of real property and buy a beneficial position in an irrevocable trust. And a chosen action, if you get an award to a lawsuit, it's not exchangeable. So let's talk a little bit more about property held for sale, because I know it's got people thinking, well, what does that mean, property held for sale? I gave you a brief description. Suppose someone goes out and buys a piece of investment property, and they decide to do maybe a few minor capital improvements and do some maintenance and repairs. They're thinking they want to rent it out. Suppose they have put it out on the market for rent, and maybe from the time they purchased it, fixed it up a little bit, put it on the rental market. Now it's not that easy to rent. They're having trouble renting it. Say they have a medical condition and they need to move and sell that property. If they decided to do a 1031 exchange, what would the IRS look at if they got audited? Or what would a CPA take a look at, which is usually based on what the IRS would think of if you got audited and try to do an exchange in a short period of time, even longer, but you'd never had rental income. Okay, so what would it look like? So one of the things you're going to want to know is the purpose for which the property was initially acquired. What did you plan to do with it when you bought it? And then during the time that you owned it, what was going on? Were you trying to rent it out? Were you still fixing it up? What happened during the length of time you owned it? The purpose for which the property was being held at the time of the sale. Like, what was going on at the time you sold it? What had you been doing with that property? The extent to which improvements, if any, were made to the property. Think of gut rehabbers and flippers. The frequency, number, and continuity of sales. Like, how often do you do this? The extent and nature of the transaction involved. The ordinary course of business of the taxpayer. The extent of advertising, promoting the other active efforts used in soliciting buyers for the sales of the property, like putting flyers up, running it on Craigslist, that type of thing. And listing of the property with brokers. Those are actively soliciting the property. Those are efforts to do that. So they're going to take a look at this whole litmus test. It won't be any one thing that's going to cause them to say, oh, you really had the intention to sell it, but it's going to be a combination of factors. So again, if you're in a situation where you did have the intent, or your clients had the intent to sell that property, or to hold that property for investment, but something happens, their good reason may not be a good enough reason for the IRS to allow it to be called investment. Please, please have a conversation with the CPA, tax advisor. And if you want to bring in a qualified intermediary for some IRS guidance or this description, I'm sure they can end up being able to accommodate you and provide you with some printed material on it. So let's take a look at some of the basic requirements in a Section 1031 exchange, or what are some of the things that are part of that tax code that you're going to elect that need to happen for it to be effective. First basic requirement, this only applies for real property. It's anything in the real estate asset class, real property that has been held for trade or business or for investment. The tax deferral requirements for a successful full deferral would be purchase a property equal or greater than the net sales price of the property. And how do you find that net sales price? And we're going to talk about allowable costs in just a little bit, but you're going to purchase a property that's equal or greater in value than the net sales price, which would be your contract price minus the allowable costs of sale. Redeploy all the cash into the purchase of the replacement property and make up any remaining mortgage balance with a new mortgage. So for example, if you're selling a property for $500,000, net the allowable costs of sale. I'm just going to say, let's just say that those, and I'm going to go over what they are in just a little bit. Let's just say that net sales price, once we minus out those allowable costs of sale, brings you down to, let's say $470, okay? So you'd reinvest and say you had a $200,000 mortgage. You would put the remaining cash into that property. If you're going to buy another $500,000 property, then you would end up putting the remaining cash in and taking a new mortgage out for the difference. So your new mortgage amount might be about $200,000, $230,000, okay? So that's how that's going to work. But all the cash goes in. Keep in mind, if an exchanger takes cash out of the transaction, regardless of whether they buy equal or greater in value or not, it's getting taxed at the capital gains tax rate. And if they take too much, they may not be able to do an exchange at all. The timeline is so important. The exchange timeline begins at the close of the sale of the relinquished property. It runs for 180 calendar days. The first 45 days of that process is the identification period, and you need to close that purchase by the 180th day. So here's where I want to take a minute, and when I said to you, this is still a real estate transaction, notice that there are things you need to do to prepare to take that Section 1031 tax election, but your timeline's not going to start until the date you close that sale. And then your identification rules are so important as to properly identifying. I have segments throughout the rest of the program. They're going to talk about all these things. So what is like-kind property? Take a break. You can take a look at all these pictures. Any kind of real property, anything that is considered real estate in the state where it's located, that you have held for productive use in trade or business or for investment. So that means taking in rental income, whether it's residential or commercial, running your own business out of it, like if you're an auto mechanic and you own the garage, or if you're a motel owner and you're running the motel, or you're holding it for investment like a chunk of raw land. So what's excluded? A primary residence, because guess what? You get the Section 121 primary residence exemption on your personal residence if you qualify under Section 121. Property held for sale and dealer property, which we just talked about. Again, I just gave you the definition. So you are selling any kind of real property held for productive use in a trade or business or held for investment. You're replacing it with property or properties that you're going to do the same thing with. And the definition of real property can be broad. So that's when sometimes, for example, that it defers to the state. For example, I just did an air right exchange out of Brooklyn, New York, because New York State recognizes air rights, as does Massachusetts, as real property. So the exchanger was able to sell those air rights above a New York building that he owned and purchase a big multifamily in Dorchester, Mass. So that's exactly what he did. But we're just going to talk about a couple of the things that you might see in your daily business, and that would be qualifying vacation homes under Revenue Procedure 2008-16. So you could sell a multifamily here in Massachusetts, and you could go buy a qualifying vacation home at the Cape or in any other state in the country. Delaware Statutory Trust is a passive investment, fractionalized beneficial ownership. When I told you that people may want to be looking for property that is, there's no management, this might be something they would be interested in. And before I advance, because we're talking about like kind, please understand that this is a federal tax code. You can exchange for any type of real property in the United States, including the United States territories, but not in Puerto Rico. Okay, for some reason, there's something up with that. But 1031 exchange is not recognized in Puerto Rico. It is in other U.S. territories, but you need to be aware of what the guidelines and any restrictions are within the territory, because it's not as easy as it sounds. So again, you're going to pull in your CPA or tax advisor if you're going to invest in the territories. But it's any kind of United States property that you're going to hold for productive use in trade or business or for investment purposes. I can't reiterate it enough. So let's talk about those vacation homes, because your brains might be firing up thinking, you know what? I've got somebody that might be interested in that. So I'm showing vacation home properties for two things. Number one, to show you the difference between a second home and a qualifying vacation property. And number two, because we haven't gotten to the key question, which I know you're wondering and you're scratching your heads over, and I probably Lauren's question box is filling up. Well, how long do I need to hold this property? Well, the guidance in vacation homes kind of gives you a glimpse as to how long you might have to hold property at all in order for it to qualify as held for investment. So let's take a look at one of the timelines that they do issue, because again, there's no timeline on how long to hold a property in Section 1031, but there is in vacation home guidance. So many tax practitioners use this as a guideline. So a qualifying vacation home, Revenue Procedure 2008-16, what's that? Revenue Procedure is an IRS rule. The year it came out is 2008. What the 16 means, I don't know. Could have been the 16th item for that day. All right, so it does create a safe harbor. A safe harbor is a protection on a taxpayer that's taking the election, that if you go by the rules, this should help you qualify for Section 1031 under this revenue procedure. The IRS will consider a dwelling unit held for investment if these requirements are met. First of all, from the date that you have, if you're going to use, if you want a vacation property to qualify for a relinquished property sale, relinquished property meaning the property you're selling, or as replacement property on the purchase side of the 1031 exchange, you have to look at it, we have to look down two different lenses. So say you have a property at the Cape, and you want to sell it as a qualifying vacation home. There's a 24-month look-back period prior to the sale, as there is if you buy it as replacement property in a 1031 exchange. There's a 24-month holding period after you acquire it. So I'm going to just talk about it from the replacement side because it's a little bit easier to do. So let's just say you're selling a single family rental somewhere here, or your client could be selling out of state. And let's just say they want to buy a property at the Cape that they're going to hold as a qualifying vacation home. For 24 months after acquisition, divided into two 12-month periods, it's going to look like this. It is let's see, it's got to be rented to another party for at least 14 days, each of the two 12-month periods. Okay, so you automatically have to have it rented for 14 days. They don't have to be consecutive. Each of the two 12-month periods at fair market rent, the income must be reported on your tax returns. You end up getting to use it yourself each of the two 12-month periods, or 14 days, for 14 days, doesn't have to be consecutive, or less than 10% of the rental time. So Lynn, what does that mean? Because it's all swimming around in my head. Well, this is what it means. It means that if you, for the first 12-month period after acquisition, rent it for 90 days, you automatically get 14 days to use it yourself. Let's just say the second 12-month period, you rent it for 180, you get like what, 17 and a half days, because it says less than 10% of the rental time. So you're just shy of that 18 days. So what happens when it's empty? It's available for rent. So remember, IRS does not like your family as much as you. So if you're renting to a family member, it needs to be rented at the range of fair market value. So this will give you the guidelines. So now let's talk about the holding. So you see a 24-month hold, correct? Well, that 24-month hold could either be, the two 12-month periods can either reside in the taxable years from January to December 31st, January to December 31st. That would be two taxable years and 2 calendar years. But suppose that person acquires that vacation property in October 1st. So from October 1st to September 30th is 1 calendar year, and it's 2 taxable years. A second 12-month period is 2 calendar years, and it's 3 taxable years. So this is one of the holding requirements that some CPAs will take a look at. Realize that second homes most likely will be taxable for one of those two reasons. If you sell them and you have not changed it into qualifying vacation property 24 months prior to a sale, here's why. If someone has a mortgage on a second home, first of all, you're allowed one other property other than your primary to take that home mortgage interest deduction. So many times people are doing that. Definitely it's going to disqualify them if they're taking that. Maybe what happens, what if they don't have a mortgage? Well, if it's been a property they've been staying there all summer long on, maybe they do collect a little bit of rent and report it. The overuse of time is going to disqualify them. So again, prior to a sale, 24 months needs to look like this. So here we go. Intent to hold for investment. Intent is one of the taxpayers, it's their subjective intent. The IRS is going to look at objective factors that either support or negate the taxpayer's intent to hold for investment. All facts and circumstances are taken into account. The holding period, that time length, again, is just one of many factors because, like I said, there are no holding requirements, but there are some things we know, like this vacation home guidance. Another one we're not going to talk about today is in related parties. Suppose Lauren was my sister and we swapped investment properties. Because we're related, remember, they don't like us. They don't like related parties as much as you do. On a property swap where we swapped investment properties, they would say we each have to hold each other's property for 2 years. So again, the time frame is one of many factors. Ideally, the taxpayer has multiple factors to establish their intent to hold for investment, and contrary facts may lead the IRS to conclude that the property was not held for investment. So, or if it was. So we've got two cases. I'm going to just check the time. How much time do I have, Lauren?
You have about 10 minutes.
Okay, I'm going to skip over the two cases because there's other things that we want to talk about, but they are in here for you to look at. This Goolsby case came out in 2010, the recent case in 2012. And so when you look at these cases and you go through, you're going to see what the IRS looked at when they were determining one of the cases. They disallowed the exchange, and the person had to pay their taxes and penalties and interest. The other case, they allowed it. So we're just going to skip those through those. Those are on the next, they're following this. So intent to hold for investment. Time is only one factor. The taxpayer's intent is the key issue. One perspective is that you hold it 24 months or more. Remember, they get this out of the vacation home guidance. In the private letter ruling on a specific case, the IRS stated that the minimum holding period of 2 years would be sufficient, and it is written into the related party section. And revenue, we already talked about vacation home guidance. Another perspective is that a minimum of 12 months. Why? Because you can take a long-term capital gain in 12 months. I just illustrated that 12 months does not necessarily mean every time the tax year changes to a new year. It means 12 months. So you could be straddling 2 tax filing years. Over 12 months qualifies for long-term capital gain treatment. And interestingly enough, back in 1999, the Congress wanted to impose a 1-year holding period, but it didn't pass. So we're back to these guidelines that are out, that they know about. Here are the cases. You can take a look at these later. Goolsby and Resync. Let's get to some of the numbers. So for a full tax deferral, a taxpayer needs to meet 2 requirements. Needs to reinvest all the net exchange proceeds and acquire property with the same or greater debt. So let's just say you're selling a property, the relinquished property is $900,000. You have a remaining mortgage balance at the time of the sale of $300,000. The cost of sale is $60,000. The allowable ones, I'm going to say them quickly, even so we can go through the other side quicker later. The allowable costs of sale are these: your real estate commission, tax stamps and recording fee, your attorney's fee, and the qualified intermediary fee if you're doing a 1031 exchange. Those are the 4 allowable costs of sale. That gives you your net equity of $540,000. Now you're going to buy a replacement property for $1.2 million. Is it equal or greater in value than what you sold? Yes, it is. You're putting all your cash into the transaction of the $540,000. You're making up the difference with new debt of $660. So therefore, there's no boot. Boot is unreinvested cash or debt. Okay, it's unreinvested value. You're replacing it in equal or greater value than you sold. So any part of the value that's not reinvested is taxable, and it's called boot. You have cash boot and you have mortgage boot. Next example, same equation, sell for $900,000, remaining mortgage balance of $300,000, allowable cost of sale $60,000, net equity is $540,000. But you're going to only buy for $700,000. So you're going to keep $100,000 in cash and put in $440,000. You're going to take a new mortgage debt of $260,000, okay, to buy that property. So you've got $40,000 of mortgage boot. Total boot $140,000, $100,000 in cash boot, $40,000 in mortgage boot. So in a partial exchange, you would be replacing at a lower value, and you would be paying tax on the difference, which is the boot. However, if the boot that you take, or the cash or unreinvested value in a transaction, is greater than your capital gain, then you're not reinvesting enough. You will not be able to do a 1031 exchange. Okay, so just keep that in mind. If the boot you're taking is more than your capital gain, you've upset the exchange equation and you will not be able to exchange. Again, for anyone that's doing a partial exchange, I always suggest as a qualified intermediary, many times the clients that have been referred to me by real estate agents or by other exchangers or an attorney or mortgage broker, anytime they call, these are things that they discuss with a qualified intermediary. But in order to get a final exact determination of their numbers as to what works and what doesn't, that needs to be done by their CPA or their tax advisor, not me as a qualified intermediary and not you as the real estate agent or broker. Okay, so next one, we've got a situation where someone sold for $900,000. Again, same formula. They're going to put $400,000 into the transaction. They're going to take a mortgage out of more mortgage money than they need. They're going to take a mortgage of $700,000. So when they leave that closing table, they're taking away some new cash at $100,000, and then $40,000 here. So what does that mean? They've got boot of $140,000, and they're going to pay tax. An exchanger that walks away with cash is getting taxed on the cash. Why would that person take a bigger mortgage balance? They're buying a property greater than what they need, but they're taking too much money. What's the problem with that? They didn't reinvest it all, and they're over leveraging. Well, and they're over leveraging. So if people want to do repairs on their property, they want to complete the exchange and satisfy it at the equal or greater value than they sold, and then talk to their mortgage lender about how to access cash to get to make any improvements or anything that they want to do. If they overborrow, the money they walk away with, even if it's held in escrow by the attorney, still taxable to them. Okay, I understand we have 5 minutes, so I'm going to zip through some of these slides because there are a couple important ones I need to get to. So we talked about allowable exchange expenses or allowable costs of sale. These are the ones that you can use the sale proceeds to pay. It will bring you down to the net sales price, which gives you your reinvestment figure, and the value of these are not taxable. If you, on a settlement statement, you're paying for these fees using exchange funds, everything on this list. Also, what's not on here is I'm seeing a lot of purchase and sales lately where I've got a seller issuing credits to the buyer. That credit that the seller is issuing, if the seller is exchanging, is going to be taxable as well. So people who are doing that need to speak with their CPA. Maybe they just lower the price. That's going to be between them. But if there's any of these fees that are going to be paid on the settlement statement using buyer proceeds, can you do it? Yes. Is it taxable? Yes. So it's a good idea for your client that's doing a 1031 exchange, when they get their preliminary settlement statement, to have their CPA review it prior to the closing to look for any boot items and determine, do they want to go ahead and just pay it out of those sale proceeds anyway, knowing that they've got a taxable event, fine, or do they want to pay for them with their own cash? Okay, one other thing is tax ownership. How you sell is how you have to buy. Most times title holders do need to stay the same, but it's more important that the tax ownership stays the same. The IRS knows you by that tax ID or social security number under which you report the income and expenses on this property. That has to stay constant. Some simple rules are, if you've got a husband and wife situation, regardless as to whether or not there's filing a married filing joint tax return, if the wife sells, the wife acquires. She's been talking about, especially if the property is equal in value. An LLC sells, an LLC acquires, tax ID number has to stay the same as for the rest of these. Now, this is just a guideline, because in some cases you have people that, say for example, they had a single family rental, but now they're going to buy they're going to buy a multifamily property or a small apartment building. They may decide they want some liability protection. If they've been reporting income and expenses under their social security number, they can form a single member LLC. They can take the individual tax election, making that LLC disregarded for tax purposes, because the number that they're going to use to file those income and expenses is their social security number. Again, the IRS knows you by that tax ID number. It has to stay constant for a period of time before the sale and the exchange of the relinquished property through to the replacement property, and for a time after, using that convoluted set of guidelines I gave you earlier. And again, discuss with your CPA. So what is the role of the qualified intermediary? It's not to give tax or legal advice. We can present the Treasury regs surrounding the tax code and provide guidance as to what that says. Also to help clients ask questions of their CPA, help them formulate those questions to ask. Our role in the transaction is this: basically with an assignable purchase and sales contract, we're assigned into the contract. The exchange agreement is signed before the sale of the relinquished property. Those documents need to be in place at the time of the closing. By way of assignment, we waive our rights to the deed. Therefore, it's direct deeding that goes directly from the seller to the new buyer. And then on the back side of the transaction, we have documents on the replacement property portion. Do know that our exchange agreement must expressly limit the rights of the taxpayers' funds that we're holding to be used only for the purchase of replacement property. Once we have the funds as a QI, we can wire those out for deposit money. Any earnest money deposit they make because they've entered into a purchase and sale contract prior to the close of their sale, they can request back as a reimbursement for the cash out-of-pocket expense for their earnest money deposit when they buy that property. So just keep in mind that you can still be negotiating this transaction for the purchase of replacement property before their sale closes. The timeline starts the date of the closing of the sale. There's exchange contract language that does not need to go into an offer or on a listing, but when the purchase and sale contract is being drafted, it can be entered then. Here's a sample of it here. There's also some for the buy side. Know that if all of a sudden you're scratching your head thinking, gee, I've got a client that's got a closing tomorrow, let me get off the phone, tell them about a 1031 exchange. They decide they want to do it. No worries, it can be added as an addendum prior to the closing of the sale. So the delayed exchange format looks like this. Again, let's just say if you look at the timeline with the 0, let's just say today is, let's just say there's a closing set for September 1st, okay? The timeline is going to start the date of the closing of the sale. The qualified intermediary is going to need to be notified prior to the close of that sale so that we can collect the data that we need as a QI in order to be able to get those relinquished property exchange docs drafted and sent out in time for the closing. So same way, again, it's a real estate transaction. They can even be looking for the property that they want to buy before the sale happens. However, they don't want to close on it until after the date of the sale. That information's gathered. Everything that you normally do, you normally do. The timeline's going to start when the benefits of burdens and ownership transfer, which is the closing date of the sale. The timeline runs for 180 calendar days. It includes weekends and holidays. The first 45 days is the identification period. If your client cannot find something to purchase by day 45, they just can't find anything suitable, don't identify, day 46, the qualified can give them their money back and they go on and pay their taxes as if the exchange never happened. However, if they identify, because the G6 restrictions and the limitation placed on the funds, if they identify, but for some reason within the 180-day period cannot close on the property, we have to hold their money till day 181. It's part of the G6 restrictions and it's written into the exchange agreement. And they have the remainder of 180 days to still try to buy that property. And I am finding out that we have 1 minute left. Can I go to? So I go to. All right, identification rules. The qualified intermediary will issue an identification notice with the property rules upon the receipt of funds from the client. They get their account summary and an ID rules. You get the 3 property rule, which allows you to identify up to 3 properties of any value. The goal to buy for full deferral to buy equal or greater in value than you sold. You can do it in a combination of 1, 2, or 3 properties. This notice must be received by midnight of the 45th day. 200% rule allows you to identify 4 or more properties, but there's a limit on the value. It can't be more than 2 times your sales price. So if you sell for $1 million, if you sell for $500,000, 2 times 5 is $1 million. You can identify 4 or more properties, but it can't be more than the $1 million. If it is, there's 4 more properties and it's more than $1 million, you got to be able to buy 95% of that property. In 19 years, I have had, I don't know, I think I can count on 2 hands the number of people that have used that one. It is difficult to do. It can be accomplished, but it's hard to do. Most people use the 3 property rule, and then in second place is the 200%. The identification notice needs to be in writing. This will explain to you, but the QI must have it by midnight of the 45th day. We do, again, provide an identification notice. Nothing we do needs to be notarized or recorded, so we can accept a fax copy of an ID notice. It can be signed, scanned, and emailed back to us, or you can use regular mail. Here's an example of what an identification notice looks like. I'm going to skip some of the correct and improper forms of ID because it's self-explanatory. I want to get to split treatment exchanges. This is so important. This is so important to me. So that'll give you an example of what works and what doesn't. Okay, what not to do. If your 180th day goes in past the tax filing date for the previous year. Suppose you have a November closing. Your 180th day is going to go past, let's just say it's April 15th. It could be the 17th, but whatever the tax filing date for that year is, if you're not going to be purchasing your property until after that date, you need to file an extension. The filing of your tax return will stop your exchange, and therefore you could have a failed exchange. This particular next case, Knight versus the Commissioner, they just closed after the 180th day. Now they have to pay their taxes and they own another property, which they were under contract for. Dobrik versus the Commissioner, backdated the ID notice. This is tax fraud, folks. I can tell you that no one at Asset Preservation will participate in the backdating of ID notices, neither should you. So just a little word to the wise there. Here's my slide. Thank you. So split treatment, what about all those owner-occupied multifamily properties that the greater Boston real estate market and other cities throughout Massachusetts has? Guess what, folks? If the taxpayer qualifies, you get to use both tax codes. So if, let's just say, I'm going to skip over to this, you have a property that you're selling for $1 million, and since I can't do math in my head, we're going to use the only math I can use. Let's just say all 4 units are the same size. Your client has lived there for 10 years, and they've rented out the other 3 units for 10 years, okay? Each of these units, if they're all the same size, they've been reporting 3/4 or 75% of this property as investment on their income tax, and their primary residence portion is worth 25% of that value. They have lived there 2 out of 5 years. They get to take the 121 exemption, which is the primary residence exemption, and deduct up to $250,000 worth of capital gain if they're single, $500,000 if they're married. Okay, so they're going to be able to take that exemption. So on the other 3/4 in this example, which is worth $750,000, they just need to go buy other investment property at an equal or greater value than they sold. So they can buy another owner-occupied property if they want, where the investment portion is $750,000 or greater, and they're going to live in one of the units. Or they can go buy a single family on their own and just go buy other investment property at $750,000 for a full deferral. So how would you deduct the allowable cost of sale on this one? They would take 3/4 of the real estate commission off the $750,000, which is the investment portion, 3/4 of the tax stamps and recording fee, 3/4 of the attorney fee, and the whole qualified intermediary fee to get that net sales price. So this works for not only owner-occupied multifamily property, but for bed and breakfast property, mixed use where maybe they are running a flower shop out of the bottom that's their business and living in the living quarters on the top. So keep this in mind when you're going to visit those owner-occupied multis. Also notice, sometimes people will move out of that owner-occupied and they will make the whole thing rental. If someone's done that, I usually ask people how long they've owned a property. If they tell me, well, I moved out 2 years ago, I ask them to ask their CPA if they would still qualify for that exemption, because the IRS will look at that 121 exemption first. And so maybe they can do a split treatment transaction. This is for your viewing pleasure. I put in steps to a successful 1031 exchange. You can email Lauren at her email address to request a copy of this PowerPoint and use this for review and for reference on your steps to a successful 1031 exchange. And then at the back, I added the like-kind exchange form. I want to say thank you. We're going to go over to Q&A with Lauren right now. Thank you for your time. My contact information is on the last slide. If you have any questions at all about anything you've heard, or you've like written materials on any subject we cover or did not cover as it pertains to 1031, please email me. Thank you.
All right, thank you so much, Lynn. If you have any questions, now is the time to write them in your chat box. It looks like we have several questions already, so I will get right to that. But first and foremost, like Lynn said, if you would like any further materials, if you would like the PDF version of this presentation, you can email me at lantone@marealtor.com. I'm going to put that in the chat box during the Q&A so that all of you have that in the written form. So let's go to our first question here. I actually tried to answer this a little earlier. It says, for restate depreciation, what was it again? 27 years? I said 27 and a half years.
Yeah, residential real estate, oh, sorry. We're sharing a microphone. Residential real estate depreciates at 27 and a half years. Realize that sometimes when people own real property, they're making capital improvements. Capital improvements are those items that can be improvements that can be depreciated as well. What are not capital improvements are maintenance, repairs, paint, and wallpaper. Did I answer? What's the next question, please?
I just sent everyone in the chat box my email address. So let's go to the next question here. The depreciation recapture at 25% is 25% of what?
25% of the total value of depreciation that a taxpayer has included on their tax returns during the length of time they own the property. So if you're doing TurboTax, you'd probably have a spreadsheet or something that you've been following along when you're doing your own taxes, or your CPA would have been tracking that for you.
Okay. Next question is the contract language, let me get that up. Okay. Is the contract language mandatory for 1031 exchange?
It's not fatal to an exchange not to have it on the sales side of the contract, specifically because the contracts are assignable by the seller by nature of the contract. If you want to email me for our template on 1031 exchange contract language, I'll be happy to send that out to you. It explains it all. Because the buyer's going to be signing the assignment agreement anyway, which is going to acknowledge their receipt of the deed by way of assignment. So that part's okay. But on the buy side, from all my years of experience, I really like to see it. Because in a situation, I actually had a person who was in Europe, and it was their 45th day. All of the power went out in the city that they were in and at the hotel. They had not ID'd their property before they left. But because they had, so there was no way we could take in the ID notice, but because they had a signed purchase and sale contract that included the language, and it was signed by both parties, and it had been signed before the 45th day, as a QI, we were able to take it as a valid ID. So I really do like to see it on the buy side of the contracts, because you just never know what's going to happen. That's just my personal opinion.
Okay, next question here. Can you do 1031 exchanges across states, like sell in New Hampshire and purchase in Massachusetts?
Yes, of course. This is a federal tax code, so it's federal. Anywhere in the United States, just remember the territories may have a little bit of restrictions, not on using 1031, but it could be to the types of businesses and things that they're going to have there. So you want to make sure that the attorney that you're working with can get you the proper knowledge. I also have a template called 1031 Exchanges into the Islands if anybody's interested. Be happy to email that out too.
Is it possible to get a recording of the webinar as well as the PDF? Yes, this presentation was recorded and will be uploaded to the website in the next couple of days. If you would like the PDF, I have in your chat box my email, so go ahead and email me if you'd like more information, if you'd like the PDF version of this presentation. Next question. Have you ever seen someone do a reverse exchange where they convince the seller of the properties they're purchasing to allow a sale contingency? This market is so tight that I could never identify a multifamily in 45 days.
Well, just remember, before you go the exchange route, true, you're able to, if you're able to find a seller that's willing to wait for you to get your property sold before you buy the replacement. That's ideal. And I like to preface this by saying, think of this as a real estate, just a regular real estate transaction. You're doing this all the time for people with residential properties anyway, because they don't want to put their furniture in storage. They need their money because the mortgage is contingent on that cash. They don't want to go rent an apartment for a month. So you're doing this daily when you're selling residential properties for people. You're negotiating contracts to allow the purchase to happen after the sale. That's why you don't need to write in any offers or anything. The fact that your client's doing a 1031, sometimes other people don't understand it. Just negotiate the purchase date for after the sale. The timeline's not going to start till the date of the sale. Now, that said, let me get to your question. In a reverse exchange, which is one of the other formats, you're able to go out and acquire your replacement property first, and it gives you the 180-day timeline to get your property sold and closed, and 45 days to ID what you're going to sell. Do realize reverse exchanges are quadruple the price. They're very expensive to do, especially on residential property. So if there's any way to negotiate, so like as a QI, we can accommodate a same-day closing, a sale first and a purchase right after the fact on the same day. But if you're what you want to keep in mind is anything that's going to go wrong with the transaction is not going to be the 1031 exchange. It's going to be maybe a lender issue, or an appraisal's not in, or they made a mistake on the payoff, and it could cause your sale to get knocked out for a day or two. So same day closings, we can accommodate them, but when structuring sale and closing dates, you want to just keep that in mind. So I know I kind of went around the barn to answer your question, but again, yes, the reversed is expensive. I'd be happy to have a side conversation with you about that on the phone if you like.
And that looks like that's all the questions for today. So as a reminder to everyone, this webinar has been recorded and will be available to view in the next few days on our website at marealtor.com. Thank you so much, Lynn, for your presentation, and thank you to everyone for joining today, and we hope to see you next time. Thank you.
Thank you.